Fortune has a story. Every number hides a truth. Welcome to Hidden Ledger, where money reveals its secrets. For decades, we've been told that inflation is a normal, even healthy, part of a growing economy. But what if the story you've always heard is only half the truth? The television screen suddenly cracks. In an instant, the comforting story disappears, revealing a far more unsettling reality. A tiny invisible 3% tax that affects us all equally. We're all in the same boat, right? Wrong. If you make $30,000 a year, inflation isn't a statistic. But if you earn millions, the experience can be very different. The government and economists use a measure called the Consumer Price Index, or CPI, to estimate how prices change over time. But CPI is only an average. No two households spend money the same way, which means inflation feels different for everyone. Your personal inflation rate depends on how you earn, spend, and save your money. To understand why inflation feels so different, let's look at 4 income levels and how each one experiences the same economy. Let's begin at the first income level, where every monthly financial decision matters the most. At this income level, most of the monthly budget is dedicated to essential living expenses, such as housing, food, transportation, and utilities. Tier 1. Annual income, $30,000. At this level, every paycheck has a clear purpose before it even arrives. Most of the monthly income goes toward housing, groceries, transportation, and everyday living expenses. Imagine your monthly budget as 10 equal parts. 9 are already committed to everyday essentials, leaving only 1 part available for everything else. Now imagine the cost of everyday essentials increases over time. The same income has to cover a little more than before. Even a small increase in everyday costs can leave very little room for savings or unexpected expenses. When everyday prices increase, even by a small amount, those changes become noticeable over the course of a month. One small increase may seem insignificant, but when several essential expenses rise together, the overall monthly budget begins to change. For many households, the adjustment doesn't come from extra income. It comes from changing how the monthly budget is used. At this stage, income mainly arrives through a regular paycheck, making each month's budget closely tied to available cash. But what happens when your income grows? Does earning more automatically protect you from inflation? Let's find out. Tier 2. Annual income, $100,000. You've worked hard, built a successful career, and reached a milestone many people dream about. You've built a comfortable lifestyle, a home, a reliable car, and a career that provides stability. It feels like you've finally made it. Along with a higher income, often comes greater financial responsibility. Housing, transportation, insurance, education, and other recurring expenses become part of everyday life. Over time, many everyday expenses gradually become more expensive, even when your income increases. You receive a 5% salary increase. At first, it feels like meaningful progress. Then, over the following months, housing, insurance, transportation, and everyday expenses gradually increase as well. Although your income has increased, your monthly expenses have grown at a similar pace, leaving very little difference in your overall financial position. You feel like you're making progress, yet financially you're moving at almost the same pace as before. Growing income is important, but long-term financial growth often depends on building ownership alongside earnings. To understand how some people better protect their wealth from inflation, we need to move beyond income and look at ownership. Tier 3. Annual income, $500,000. At this level, the conversation begins to shift from earning income to owning assets. Unlike the previous tiers, wealth at this level is no longer centered only on a paycheck. A growing portion is connected to ownership. Assets such as diversified investments, real estate, and ownership in businesses may increase in value over long periods, although performance is never guaranteed. When businesses adjust prices over time, the value of many ownership-based assets can also change, depending on market conditions. Over long periods, many investors aim to grow their wealth through ownership rather than relying only on earned income. Instead of depending on a single source of income, diversified ownership can provide multiple ways to participate in long-term economic growth. Cash provides flexibility for everyday needs, while long-term ownership is often used with the goal of building wealth over time. Over time, the combination of earned income, disciplined saving, and diversified ownership can strengthen a financial foundation. Protecting wealth is one step. The next step is understanding how large-scale investors often use capital to create new opportunities. Now, let's look at the highest income tier, where the discussion expands beyond earning and ownership to the strategic use of capital. Tier 4. Annual income. $5 million or more. At this level, financial decisions are often centered on managing capital over long time horizons. At this level, capital is often directed toward long-term projects, operating businesses, and income-producing assets rather than remaining idle. Large projects are often financed through a combination of equity and long-term loans, allowing capital to be allocated across multiple opportunities. Over long periods, fixed-rate financing can change in real value as the broader economy and prices evolve over time. As time passes, both assets and financial obligations can be influenced by changes in the broader economy. Long-term results depend on many factors, including market conditions and careful planning. Successful long-term investors often focus on how capital is allocated across different opportunities rather than relying on a single investment. Instead of depending on a single source, long-term financial strategies often combine multiple sources of potential growth. A diversified portfolio is designed to balance different types of assets, recognizing that each may perform differently over time. Looking only at income tells part of the story. Looking at assets, liabilities, and long-term planning provides a more complete financial picture. The key idea is simple. The way inflation is experienced often depends on how income, spending, savings, and ownership are combined over time. Everything changes when your primary source of wealth is no longer your paycheck, but the assets you own. At this level, cash is mainly used for liquidity, while a larger share of wealth is typically held in long-term assets. When businesses and productive assets grow over time, owners may participate in that growth alongside the broader economy. When companies expand and create more value over time, the assets connected to those businesses may also increase in value. Over long periods, ownership allows people to participate in the growth of businesses and productive assets, instead of relying only on earned income. As income grows and ownership increases, the financial impact of inflation can feel very different from one household to another. For many investors, the long-term goal is not simply earning more income, but gradually increasing ownership of productive assets. Diversification doesn't eliminate risk, but it can help reduce dependence on any single source of income or investment. Over time, a combination of disciplined saving, consistent investing, and long-term ownership can strengthen financial resilience. But ownership is only part of the picture. To understand how large-scale investors operate, we need to look at how financing and productive assets work together. Now we arrive at the highest income tier, where financial decisions are often driven by capital allocation rather than day-to-day spending. At this level, the focus often shifts from earning each additional dollar to managing capital efficiently across multiple opportunities. Large portfolios are often built around productive assets that generate value over long periods, rather than relying on a single source of income. Instead of relying primarily on a paycheck, income can come from multiple long-term sources, including investments, business ownership, and real estate. Strategic financing can allow investors and businesses to acquire productive assets while preserving capital for future opportunities. When financing is arranged with long-term fixed terms, the future value of repayments can be influenced by changes in inflation over time. As prices change over time, the purchasing power of money changes as well. This can affect the real value of future payments and financial obligations. Historically, some productive assets have been able to adjust alongside rising prices, although outcomes vary depending on markets and economic conditions. Over long periods, ownership can allow investors to participate in the growth of productive businesses and assets instead of depending only on earned income. Understanding how ownership, productive assets, and long-term planning interact provides important context before we examine the final example. Now let's look at the final tier, where large-scale investing, financing, and long-term ownership often work together. Large investors often focus on directing capital toward assets that generate long-term cash flow and economic value. Imagine an investor purchasing a large apartment community using a combination of personal capital and long-term financing. Over long periods, well-located real estate has often appreciated in value, although future performance is never guaranteed. As demand, operating costs, and local market conditions change, rental income and business revenue may also change over time. If financing terms remain fixed while the economy changes over time, the relationship between asset value and repayment obligations can also change. Over many years, the combined effects of asset growth, cash flow, and fixed financing can significantly influence long-term financial outcomes. The effects of compounding can become more noticeable over long periods. Viewed together, ownership, financing, cash flow, and long-term investing create a broader picture of how wealth can evolve over time. These examples illustrate why the experience of inflation can differ widely depending on income, spending patterns, asset ownership, and financial structure. Let's step back and look at the complete picture. Each income level can experience inflation differently because financial priorities and asset ownership are rarely the same. Across every income level, one principle remains consistent. Understanding how money works is often more valuable than simply earning more of it. So instead of asking only, "How much do I earn?" it may be more useful to ask, "What do I own, and how is it working for me over time?" Over time, financial outcomes are shaped by many factors, including income, spending habits, saving, investing, and ownership. The most important lesson isn't that everyone experiences inflation the same way. It's that understanding your own financial position can help you make better long-term decisions. Whether you're just beginning your financial journey or managing a diversified portfolio, informed decisions made consistently over time can have a lasting impact. So the question isn't simply how much money you make. It's whether your financial decisions today are helping build the future you want tomorrow. Inflation affects everyone, but not always in the same way. Understanding that difference is one of the most valuable lessons in personal finance. The economy is constantly changing, but one thing remains true. The more you understand how money, ownership, and long-term decisions interact, the better prepared you'll be for whatever comes next. The question is no longer, what is inflation doing? The question is, what will you do next? Thanks for watching Hidden Ledger. Next time we'll uncover why the rich keep getting richer, even during a crisis.